Hello everyone and welcome to another episode of Common Law and Simple Flow. Today we are going to talk about capital gains tax. What is CGT? Capital gains tax is charged on the profit, the gain you make when you dispose of a chargeable asset, for example, shares, investment, property, crypto, valuable art. Gain is Gain means disposal proceeds minus allowable costs, for example, purchase price, certain fees like stamp duty, broker legal fees, improvement costs, etc. So you are not just considering what you have received from the buyer, but you take the price. For example, you have sold a painting for 1,000 euros or pounds, and you are deducting allowable costs. Purchase price, what do we understand under purchase price, is the price that you have paid when you purchased it initially. Like you don't have the painting just from the air, like it just appeared in your assets. No, you have purchased it some time ago, maybe a couple of years ago, and you're deducting this purchase price if it was £500 from your 1,000. And if there were stamp duties for land, for example, or broker fees or legal fees or any other costs like improvement costs, you are deducting all those, and they are called allowable costs. CGT is charged on the gain, the profit, not on the wholesale price. This is what I meant. Parents bought the flat for £1 million plus any buying costs. 10 years later, they sell it to you for £1, but you are connected person, parent-child. For CGT, HMRC treats the parents as if they received market value £1.5 million, even though you actually paid £1 only. So even if your parents are paying you have bought for £1 million and current market value of it is £1.5 million and you received it only for £1, it is still considered, HMRC will treat that the real price is the market value for that flat, and it's 1.5 million pounds. And even though you actually paid £1, chargeable gain is considered for your parents £500,000 before any relief applies. So we're not talking about reliefs yet. We are saying that an apartment costs £1 million and they are selling it to you. Doesn't matter what's the price. We are considering the real market value, and it will be £500,000. And this only works for connected people, connected persons. They can deduct allowable costs, purchase, sale, legal fees, stamp duty on purchase, capital improvements, and then apply any reliefs allowances. So we will eventually deduct the purchase cost, which is £1 million. We're not saying your gain was £1.5 million. No, the gain was 1 million. Now let's talk about disposal. It's not just a sale. We consider disposal a gift, a transfer, an exchange, or disposing a part of an asset. These are all considered disposals. If you give something away for less than it's worth, for example, a gift to a family member, HMRC usually substitutes market value as the proceeds. You can't avoid corporate gain tax by selling your flat or land only for £1, and this was the example about it. Death is not a disposal. When someone dies, there is no CGT on death, corporate gain tax. The assets pass at market value to the personal representative PR's estate. Later, if PR sells during the administration period, CGT can arise in the estate on any gains since date of death. So the date of death will be considered our starting point for evaluating the gain on the price. If the assets are transferred to beneficiaries, the beneficiaries take them at the date of death market value as their new base cost. CGT only arises if when they dispose later for gain. Let's go through an example to understand it better. Your aunt bought shares years ago for £10,000. She dies on 1st March 2025 when the shares are worth 30,000. You inherit them. Your base cost is £30,000. The market value, probate value at death. No CGT at death. If you sell on 1st July 2026 for 36,000, your chargeable gain will be 36,000 minus 30,000 will be 6,000, ignoring costs and allowances. The 20,000 growth that happened during your aunt's lifetime is not taxed on you for CGT. And this is important point. So the death creates a new timeline for the base value, and the HMRC will consider only that new base cost. The beneficiaries will get only CGT, corporate gain tax, on the gain which was increased, which appeared after the death of the person. What counts as proceeds? Proceeds are what you receive for disposing of the asset. So it's basically the payment that you receive for disposing your asset. If you sell something, then you receive something in return, and we are calling that consideration received. So proceeds is not the asset itself, but the profit that you have gained when disposing the asset. We can have several types of proceeds. Cash now or later, deferred payments, installments do count as well. So later payments, which are deferred payments or paying in installments every month, this will also count as proceed. Non-cash consideration counts at market value. For example, you swap your painting for someone's car. HMRC treats you as receiving the car's market value because it's reasonable. If you receive a car, you cannot say I'm getting this car, but the car I'm getting in value of 100 euro, but in fact the car costs 15,000 euro. Rights to future payments. For example, an earn out where the exact amount isn't known at sale. This generally still counts. Either you are treated as receiving the value of that right up front, or the right is a separate asset you will later dispose when it pays out. The detailed treatment depends on whether it's ascertainable at sale. Since this was a bit complex, I have simplified it quickly. Rights to future payments. This refers to situations like an earn out. You sell today, you get some cash now. You may get more money later, depending on future performance. The exact amount isn't known at the time of the sale. The key question here, the tax question. Do you pay tax now or later? This depends. The tax law says you can't ignore that future money just because it's uncertain. So it uses two possible treatments depending on if it was ascertainable. You were taxed upfront because the future gain is certain, and if it was unascertainable, taxed only when paid because the future gain is uncertain. So you're taxed only when you receive the gain, because the future gain is uncertain, so we're waiting until you receive it. With the examples it will be more clear. Earn out ascertainable at sale. The earn out can be reasonably valued at 200,000. Disposal proceeds at a sale 1.2 million. So let's go through the first example. Earn out ascertainable at sale. You own a software company and sell it to a larger firm. At the time of the sale, buyer pays you £1 million now. Buyer promises an earn out. You will receive 10% of revenue generated from your software over the next 2 years. Based on existing contracts and renewal rates, advisors estimate the earn-out is likely worth about £200,000. Disposal proceeds at sale will be now 1.2 million, and CGT will be charged now on 1.2 million pounds. Later, if you receive 230,000, the 30,000 will be extra gain and you will pay extra CGT on that. If you receive 100,000 pounds, then there will be minus 20,000 pounds. So it will be your capital loss and you will get capital loss adjustment basically for the next years. And in the case 2, when there is earn out on unascertainable level at sale and you are getting 1 million pound and it's not clear what will be potential future gain. So that's why you are not charged anything and you are paying CGT only on this 1 million pound. But later, if you get this extra payment, which is, for example, 220,000, then CGT will arise on that amount, but as soon as you get the payment. So these were examples of proceeds. Just once again, you are getting cash now or later. You are getting non-cash consideration, for example, a car. When you are swapping your house for a car, then you are considering the market values of that, and rights to future payments, which are with earn out, when you will get extra money in the future. So you are paid both now and you will be paid in the future as well. Types of chargeable properties. Almost anything that has value can be a CGT asset. Land, buildings, shares, crypto, artwork, goodwill, rights, not just physical things. So anything that has value, that can have a price tag on it, is a CGT asset. That includes intangible interests like a co-owner's right to a share of the sale proceeds of land. If you hold only the right to money that will come from a future sale, that right itself is an asset for CGT. So it shouldn't be always physical. It shouldn't be always money. It can be land, shares, buildings, but it can also be right to something that doesn't exist yet, for example, or you have a right to share proceeds. The proceeds are not available yet. So cash itself is not a chargeable asset for CGT. If you simply dispose of cash for cash, there is no CGT. Imagine in the currency exchange, you will give 100 euro to get $110 and you pay CGT on that. The proceed, for example, whether there is some tiny proceed, I don't know, or if you are paying money to get money, there is no CGT in cash. Spouse civil partners transfers, normally treated as no gain loss. The giver is not charged to CGT and cannot claim a loss. The recipient takes the asset with the giver's base cost. CGT is effectively deferred until later disposal outside the couple. So it's important to clarify this. Inside couple exchange, you can sell to your husband or wife and there will be no CGT, but outside of the couple there will be CGT. As soon as it stays in the couple, no CGT applies. Examples with spouses. Taylor bought shares for £20,000 and transfers them to their spouse Sam when they are worth £35,000. Taylor has no gain, no loss now. Sam's base cost becomes £20,000. If Sam later sells for 40,000, Sam computes the gain from £20,000. So when you are selling to your spouse, there will be no reinitiation of the base cost. If you bought it for 20,000, now selling to your partner for 35,000, the base cost will still be £20,000. Charities. A disposal to a charity generally does not create a chargeable gain or an allowable loss for the donor. Relief applies, so there is no CGT at that point. So when it comes to charities, there is no capital gain or capital loss. Let's say You bought shares for £10,000. You are now worth they are now worth 30,000, and you donate them to a charity. Normally selling at £30,000 would create a £20,000 gain, CGT. But because the recipient is a charity, relief applies, so no chargeable gain arises for you on that disposal. Result will be no CGT to pay at the time of the gift. They are now 6,000 of worth and not 10,000. So you donate them to charity. Normally selling something what was earlier 10,000 and now is 6,000 would create a 4,000 loss for you as a capital loss, and you can use against your other gains. But charity relief means the disposal creates no allowable loss either. Result is you can't claim that £4,000 loss. Okay, now let's go back to the beginning. Date of disposal. The date of disposal is specific legal date your disposal is treated as happening for corporate gain tax timing. It is used to fix the tax year and rates allowances that apply. CGT only crystallizes at disposal. You are taxed on the gain measured at the disposal, proceeds minus the base cost, even if most of the increase happened long before. So let's say if you have a gain very early, like 20 years ago, you had a huge gain, and back then the tax rates were lower, the allowances were higher, and now the tax rates are pretty high and the allowances are very low. You are still taxed with rates and allowances for this year and not back then. So the disposal itself will crystallize the corporate gain tax. Unconditional contract. The disposal date is the date the contract is made, exchanged, signed contracts with each other. So when there are no conditions in the contract itself, the disposal date will be the date when the contracts are exchanged. Unconditional means there is no condition that must be satisfied before the deal is binding, even if completion and payment happen weeks later. The disposal date is the exchange date. Basically, exchange is when you are exchanging the contract, and completion is when you complete the deed of the contract, and the payment also happens later. So for us, if the contract is not conditional and it doesn't say only when this happens, then the contract will be considered as executed. Okay, conditional contract. The disposal date is the date the condition is satisfied and the contract becomes legally binding. The contract becomes legally binding when there is exchange of the contract. So the contract should have been exchanged already, and the condition can be connected with the future. If the contract only becomes binding when a condition precedent is satisfied, for example, planning permission, third-party consent, the disposal date is when that condition is fulfilled. Land and buildings. The disposal date is the date of exchange of contracts, not the completion date. Property sales are often exchanged first and completed later. So we are exchanging the contracts, and the completion, the deeds itself, are executed later, basically signed and confirmed and declared as deed, also delivered as deed. For corporate gain tax, the key date is exchange, provided it's unconditional on exchange. So if it is unconditional, basically if we now view unconditional contract and land building contract, they are the same, because in both cases the exchange of contracts is the point when you are considering the disposal date. And now let's understand the difference between exchange of contracts and completion. Exchange of contracts. Buyer and seller sign identical contracts and become legally bound. Consideration in form of promise is exchanged. A deposit, often 10%, is paid. A completion date is agreed. And for CDG timing, if the contract is unconditional, the date of disposal is exchange date of contract. Completion the rest of the money is transferred, ownership actually passes, you get the keys, title is registered after completion, the UK residential property CGT reporting payment, the 60-day clock runs from completion, even though tax year is fixed at exchange. So that you understand better what this means, this 6-day clock is the reporting and payment for the corporate gain tax. This rule says you must file the UK property CGT return and pay any corporate gain tax due within 60 days of completion, not from the exchange date, because exchange date fixes only the corporate gain tax, but your clock starts to run after the completion, and you have 60 days to actually pay the tax and file the return. And under filing return, we understand the reporting part, how the financial details, basically how much you also need to pay, etc. For example, exchange happened on 28th of March, and this gain belongs to this tax year because exchange was in this year, and completion happened on the 15th of April. And starting from 15th of April, we count this 6-day clock in order to understand until when you have to pay the tax itself, until 14th of June. Okay, great. Who pays a CGT? Individuals. If a person sells or otherwise disposes a chargeable asset for a profit, they may owe CGT. Partners in a partnership, personal representatives, and trustees. A partnership itself, just a second. A partnership itself isn't taxed for CGT. Instead, any gain is split between the partners according to their profit shares, and each partner pays capital gain tax on their share. We know that the partnership doesn't pay tax. Everything goes through members. Personal representatives, PRs. After someone dies, if the estate, through the PR executor, sells an asset during the administration period and makes a gain, the estate may owe corporate gain tax on that gain. Trustees, if a trust disposes, and trustees, personal representatives are almost the same. Personal representative is just representing the estate when person dies. A trust and trustee is just a general trustee who holds something for beneficiaries. If a trust disposes of a chargeable asset and makes a gain, the trustees are the ones who may owe CGT on that gain under trust tax rules. Important is that the companies don't pay CGT, corporate gain tax. Gains are under corporation tax. So if they sell the assets, all the assets that we have discussed, buildings, lands, shares, everything goes under corporation tax, and there will be no capital gain tax. Let's now continue to the rates. CGT isn't one flat rate. It varies by asset type and who is paying. Residential property gains rate. So, as I said, residential property gains. Residential property is property that is meant for people to live in. Dwellings are also residential property. A dwelling is a home, a place someone can live in. Houses, flats, apartments, bungalows, mansionates, student flats used as homes, etc. It generally includes the normal garden grounds up to a reasonable size. So dwelling, it is also a place where people live. Off-plan purchases are also residential property. You buy a home that hasn't been built yet or is still being built. You exchange contracts now for a future apartment house and complete when it's finished. That's still residential for CGT purposes. So even a home that hasn't been built yet or is still in the process of being built, it also considers a residential property. Mixed-use properties follow special rules. Mixed use means part residential, part non-residential. In the same title, for example, a shop at street level with a flat above, or a farmhouse with commercial barns run as a business. Because it's not purely residential, CGT and sometimes other taxes can be calculated differently, often by apportioning, creating the portion of the gain between the residential and non-residential part and applying the relevant rules rate to each slice. Buy a new build flat off plan in 2023, complete in 2025. That's residential. What do we understand under deemed occupation? Deemed occupation before moving in. If you buy or start building, renovating a home, intending to live in it as your only or main residence, the period before you move in can be treated as if you lived there for up to 12 months normally, and up to 24 months in reasonable circumstances. For example, construction delays, renovations, trouble selling your old home, etc. Conditions: you must actually move in and make it your main residence once it's ready. Now you may not understand why is this important, but in later calculations you will understand. So let's just understand deemed occupation is when you are building a home or renovating it. You don't live there, but your main purpose is after the renovations are over, you will live there. And the first 12 months will be considered as you have actually lived there, although you were not living there. So it's called deemed occupation. And this 12 months may become for 24 months, up to 24 months, if there were reasonable delays or any troubles. But the main condition is that eventually you live there. So you move there and you live there for a couple of years. If you don't do that, it will not be considered as deemed occupation. So you may plan to move there, but then you suddenly sell and move somewhere else. What if you buy a new build flat off plan in 2023, complete in 25, and before moving in, you sell it? Is it still residential? It is still residential for CGT rate purposes. Off-plan flip, signing the contract before completion. You are disposing of a right to acquire a dwelling. That counts as a residential property interest. So residential CGT rates apply. There is no PPR, principal private residence relief, because you never lived there. So this is a relief that we will talk about now. Then complete, then sell without moving in. You're disposing of a dwelling you never occupied. Still residential for rates, but no relief for principal private residence. Now let's just move forward and we will understand what is this difference between residential and non-residential and what are these reliefs. Just to understand, we are here at residential property gains rate, but we firstly had to understand what is residential property. So principal private residence relief, PPR. If you sell your main home, you can usually pay no CGT if key conditions are met. You lived in it as your only main residence, didn't let it out or run a business there, and the total land is under 5,000 meters square. So that was your main home, your main apartment, and you will not pay corporate gain tax if you sell your main home. The whole purpose is for it that when you sell your main home, you get as much money as possible. But there are some conditions. It should be your only and main residence. So you may have other houses as well, but it should be your main residence, or you just have only that one house. You didn't give it for a rent, so you will live there 10 years, but 5 of it you have leased it out to some other people. And you haven't run business there. The total land should be also smaller than 5,000 meters square, which is a lot. So, wow, this will be long. Let's just go through the left part. Principal private residence relief can reduce the residential slice to 0% for periods it was your genuine main home. 60-day reporting applies to UK residential property disposals. So after the completion, you have this 60-day clock where you should provide a report and pay the actual tax. If you sell UK residential property and there is corporate gain tax to pay, you must file a special online return and pay the corporate gain tax within 60 days of completion, the day money keys change hands and the deed is signed, etc. So this is not the exchange date, but completion, and we have talked about it. This rule applies to UK residents. MISIT and HMRC can charge interest and penalties on it. So who is paying this? UK residents. 60-day report only if CGT is due on a UK residential disposal. So after completion, you have 60 days as UK resident. If reliefs, PPR losses, or the annual allowance reduce the bill to £0, you don't file this 60-day return. So even if you have to pay nothing. No, if you have to pay nothing, your bill is 0, you will not have to do this 60-day return. This is designed for that normal people, when they are selling their main houses and the PPR, the principal private residential relief, is applied, then they will not pay any taxes. They will not get penalties and interest on that amount, and especially if the amount is 0 itself. But when we're talking about non-residents must file the 60-day UK property return for any UK land property disposal, even if no tax is due. It includes indirect disposals of property rich entities. Property rich, if I'm not mistaken, it was this properties, the value of which is built from 75% of UK-based gains. So UK is giving 75% value to that land. So once again, for non-residents, the 60-day return and payment is important and mandatory. And even if there is no tax to pay, there is still obligation to do the reporting. Now let's go back. Let's play with numbers a bit. If PPR doesn't apply, the residential property, this principal private residence relief, then we may pay tax. Gains on residential property are taxed at 18% or 24% for individuals. Which one you pay depends on your income bands. So 18% and 24% are for individuals who are selling and making a gain on their residential property, and a flat 24% for trustees and PRs. So you know that trustee and PR, they have the same role, and 24% will be a flat value for them. So there is no 18% for them, just 24%. Residential includes dwellings and off-plan purchases. Mixed use, like shop and flat, have special rules about this apportioning. So the tax rates, as we understand, are 18 and 24. 18 is before a specific threshold. It's before 37,700, and after 37,700, it will be 24%. And now we have here Nelson Mandela and Marlon Brando for 18 and 24. Let's quickly go through this part as well. This was the principal private residence relief, and now let's understand what is this text mostly about. If you live with your spouse civil partner together, you can claim principal private residence relief, PPR, on only one home between you at any time. If you both have homes, you can jointly nominate which counts as the main residence, normally within 2 years of the situation arising. If you separate, each may have their own main residence from that point. So this is a loophole because I assume many couples would potentially separate in order to keep to have two different main residences. So if you both have homes, you can jointly nominate which counts as the main residence, normally within 2 years of the situation arising. So before 2 years, you need to nominate which was your main home. You and your spouse, civil partner, can only have one main residence for corporate gain tax at any moment. If you two own two places you actually use as homes, you can nominate which one is the main home, and you can change that later. Can we sell a tax-free? Can we sell A tax-free, then move to B and sell B tax-free? Yes, if each one is genuinely your main home when you claim it. Live in home A as your real main home, sell A, usually no corporate gain tax, the PPR relief, then move into home B, make it your real main home. When you later sell B, the period you lived in it as your main home is exempt, plus the final 9 months of ownership. Anytime you owned B before it became your main home is normally chargeable on a time apportionment, unless specific absence relief applies. So if you sell A and then move to B, but you have had B for 40 years and you live in B only for 2 years, and you sell it, you will be tax-free from corporate gain tax only for 2 years. The other 38 years will not be tax-free. So this is an important point. From 2018 to 2024, you live in A main house. You also own B, but don't live there. In 2024, you sell A. No corporate gain tax will apply. You move into B and make it your main home. In 2027, you sell B. The years 2024 to 2026 plus final 9 extra months are exempt, and the 2018 to 2024 period is usually taxable. So exactly what I have said. The period that you didn't live in your house will not count free of tax. When you sell a home that has been your main residence, the part of the gain that relates to the time you actually lived in it as your main home, plus the final 9 months of ownership, is ignored for CGT. You don't pay CGT on that slice. Example, owned for 60 months total, lived there as main home for 36 months, and then rented it out for 24 months. On sale, the exempt period will be 36 months, the period that you lived there, plus 9 months, so altogether 45 months. And let's mark it also with a red star, because the period when you lived in your apartment will be free of charge, and the rest of the period will not be. Where is our calculation? Here. 36 months plus the 9 months. So altogether 45 months will be free of tax. If your total gain is 60,000, the exempt portion is 45 divided by 60 multiplied with 60,000 pounds will be 45,000 pounds of free of CGT. So no CGT on this. The taxable portion is the rest, 15,000 pounds before allowance, losses, reliefs. Okay, now let's go through some numbers. So the tax calculation goes in this way. We have 18 and 24% and 24% for trustees and PRs always. CGT bans work for individuals in 2025, 26, and this will be for 26 and 27. So step 1, work out your taxable income for the year. After the personal allowance of the 12,570 tapered above 100,000. So everything that goes above 100,000, you are reducing each 1 pound with 2 pounds for every £2, you reduce it with £1. So step 2, after you figured out how much your income tax is, work out your total gains property disposal, the CGT subject. So how much exactly is your total gain for capital, from capital. Deduct losses, your basically the purchase price, etc. So we will need the pure CGT subject amount. Then deduct the annual exempt amount for CGT, the 3,000 for individual. And here again, we will need a red star because we should not forget that it is 3,000 exempt for capital gain tax. And step 3, add the taxable gains to your taxable income to see how much of the gains sit within or above the basic rate band. So if you had 30,000 income tax and you had 10,000 of capital gain, then this altogether will be 40,000, and you need to understand which part of this 10,000 sits before 37,700 and which part sits after 37,700, because what sits before this threshold will be 18% and what sits after will be 24%. How to remember them? Nikola Tesla and Ludwig van Beethoven with 37 and 70. They will be our helpers to remember these numbers. So let's firstly start with Nelson Mandela and Marlon Brando. Nelson Mandela comes into a room where Godfather sits, and Nelson has brought some capital gain tax to pay him. But Marlon is doesn't have mood that day, and he turns off the light. But then Nikola Tesla comes and turns on the light, and instead of Marlon Brando, Ludwig van Beethoven's poster stands there, and then Godfather is super surprised. So step 4 is to apply the rate slice by slice. 18% on the portion that falls within the basic rate band and 24% on any portion above it. So same 18% and 24% for residential and other assets, and 32% applies to carried interest. The carried interest we will know here, it's the ventures. When ventures do have their bonuses, the managers, for example, in venture, this is called carried interest, and the rate of that is 32%. But it's like very edge case and rare. Now taxable income. Let's calculate some. You have 25,000 income, your personal income. That has nothing to do with capital gain. Capital gains after losses and the allowance. Let's say capital gains so that you clearly understand. And the 33,000 allowance are implemented, and you have 20,000 capital gain. 25,000 plus 20,000 will be 45,000. So the basic rate band is Nikola Tesla and Beethoven. We have 37,700. So now we need to understand what sits before that. For gains before this sum, we need to subtract, and we will have from 37,700 take out 25,000, and we will have 12,700, and 12,700 will be taxed with 18%. For gains before, for gains after 37,700, we need to, we have two options. Either we take this 45,000 and take out 37,700, because everything remains between these two thresholds, and it will be 7,300. Or we take our capital gain and take out what we have already used before this threshold, so the previous sum here, 12,700, and it will be the same sum. Do it in most comfortable way for you. For me, the better approach is this, because we always, if capital gain basically sits between this, and most edge cases are this one, the common cases, also that they have 37,700 in between, and then we're just taking out from our main taxable income this 37,700, and we will get 7,300 multiplied with 24%. And Trustees personal representatives pay always 24 on gains, doesn't matter this threshold. Why? Because trustees and personal representatives represent a state and they do not have income tax. They are like mini corporation, mini company, but they are in fact not a company. And companies, as we know, don't pay CGT. They pay only corporate tax. And again, this couldn't be more important. Now let's move to non-residential gains rate. The shares, crypto, commercial property, land that isn't a dwelling, so isn't a house, and people do not live there. This uses the non-residential rates. And the non-residential rates and residential rates are the same. Again, 18% and 24%. And for trustees and PRs, again, 24%. Okay, PRs, again 24%. Why this is separated? Because historically non-residential gains were 10 and 20%, but were raised to 18 and 24 from 2014. That is the reason why the percentages are the same for both categories. Maybe in the future they will change again. And now carried interest. As I said, some private equity venture capital fund manager get a performance bonus that's a slice of the fund's profits. Basically, venture sells something and you get bonus for that. That slice is called carried interest because in fact you get money, but you get money from the company because a capital gain was sold and you're getting bonus. And that bonus is taxed under corporate gain tax rate of 32%. Not the usual 18 or 24, which is higher. A fund makes 100 million profit. The manager carry is 20% to, which is 20 million to the manager. Like manager gets 20% of the slice, and it's just an example. I mean, this 20% could be anything, 10, 15, I don't know. The idea is they get 20 million % bonus, and CGT on carry, it's 32% of this 20 million will be 6.4 million will be your capital gain tax, which is huge. All right, that was it for the rates, and I think this was the most important part because all the calculations will be then based on this. Let's quickly go through non-UK residents. If you're a non-UK resident and you dispose a UK land property, you are taxed at the same CGT rates as UK residents. Individuals 18% within basic rate band and 20%, 24% above. Indirect disposal. Instead of selling a UK building itself, you sell shares in a company or units in a fund that mostly owns UK property. Basically, you're not selling UK building, but you're selling shares of that UK building. Okay. When does the UK tax you as a non-resident? And we have already seen this in some other flows because it's a duplicate. So as non-resident, you are taxed by UK. In case of property rich test, it's the company fund is UK property rich if at least 75% of its value comes from UK land property. 75% is UK property. And ownership test, you plus your connected people altogether owned 25% or more of that company at any time in the last 2 years. So in fact, UK property rich means that here we are talking about company, that a company owns shares basically. And here shares at any time in the last 2 years. So why is this relevant? Because when you are selling shares of a company, you will get residential tax. So just let's pause for a while and understand what is this about. This is describing when the UK can charge CGT on a non-resident who sells shares units in a company or fund that is heavily backed by UK property. Normally, if you are a non-UK resident, you sell shares, the UK often wouldn't tax that because you're not UK resident, you have nothing to do with UK. But the UK makes an exception to stop people selling the wrapper, the company, the the parent container, so to say, instead of selling the UK property directly. Let's bring a simple example. You live outside the UK, you're non-resident. You own 30% of a company. The company mainly owns UK residential rental apartment buildings in London. Company's value is 80 million, and that 80 million consists of London apartment buildings, UK land property. 20 million is cash plus other investments. So 80% is UK property. It means that this is property rich. You sell 30% shareholdings and make a gain. Because the company is 75% more UK property rich and you own more than 25% in the last 2 years, the UK can tax your gain, CGT, even though you are non-resident. So you will be target of capital gain tax even you are not a resident. Result is, if both are true, the UK treats your share sale like a UK property sale and CGT applies. So although you are selling shares, but it will be treated like a property. And capital gain tax will apply. If your holding was always under 25%, you are generally outside this rule. So if it's always under 25%, your ownership and with your connected persons, then you are not target of CGT. Code by the rule. You and your spouse together hold 30% of company whose assets are 80% UK property. You sell your shares while non-resident, and although you're non-resident, this will be taxed in UK on the gain. Not code. You hold 10% of REIT like vehicles, that's 90% UK property. Your stake is below 25%, so no UK capital gain tax under the indirect disposal rule. Though other countries taxes may apply. So it's not about the taxes of other countries, it's about what the UK will do. If you're a non-UK resident, you don't live in UK, you have nothing to do with UK, but you still pay tax of capital gain. Quick checklist. Is the entity more than 75% UK property? Did you plus connected persons have more than 25% at any point in the last 2 years? So at any point, it can be a short period that you had more than 25%. If yes, plus yes, UK corporate gain tax. Otherwise, usually no under this rule. All right. Annual exempt amount. We talked about it already. The CGT basic allowance is the annual exempt amount, AEA, the amount of gains you can make each tax year before any capital gains tax is charged. Every individual, adult or minor, gets a tax-free CGT allowance each tax year. So every tax year, you will have £3,000 of AEA. How much is in 2025-26? It's 3,000 for individuals and personal representatives, and for most trusts it's 1,500, so 1,500, or 3,000 for trusts for vulnerable disabled beneficiaries. So if your total net gain after same year losses are less than 3,000, you pay no CGT that year. Anything above 3,000 is taxable. Applies to UK residents on any chargeable gains and non-residents on UK taxable gains. So you know, non-resident story. How it works, quick rules. You offset losses first, then use AEA against the remaining gains. So if you had losses during previous years, for example, or that year as well, you just offset them. So basically you subtract all your losses from your current gains, and only after that you apply your AEA. You can set it against the highest rated slice to cut bill most. This £3,000 is per person per tax year. Unused AEA can't be carried forward, and this is important. So if you haven't used it, it will not carry forward. It will stay in the same years, and it also cannot be carried back. But spouses, civil partners can transfer assets between themselves, no gain, no loss, before a sale to use two AEAs. So the spouses, civil partners, can do transfers of their assets in order to use 2 times of AEA. Personal representatives, executors, can use the 3,000 AEA in the year of death and the next 2 years during administration. So even personal representatives here, they're 3,000, they can use it, not forever, but on the death year and the next 2 years during their administration. Here again, the AEA is use it or lose it, can be carried forward or back. You have 8,500 of gains and 2,000 of losses this year. Taxable gains are 6,500. Use your AEA 3,000, leaving 3,500 taxed at applicable CGT rates. Person dies on 10th January. This is the tax year 2025-26. Estate sale. In May 2026, you gained £4,000. You used your AEA. It's 1,000. Estate sale 2, November 2026. You gained £10,000. And you used AEA £3,000, so 7,000 will be taxable. So a small correction to understand more clearly. So 10th of January 2026 is still tax year of 2025-26 because it's the beginning of 2026. So with April and May, the new year is starting. So the UK tax year, it starts on 6th of April and it ends with 5th of April of the following year. So 10th of January is still the tax year of 2025-26, and this is the death year of the deceased. And the first estate sale happens in January 20. We're still in 2025-26. So we can use this 3,000 and taxable income on 4,000 will be only 1,000. Estate sale 2 will be November 26. It will be already 26-27. We get 10,000 minus 3,000 AEA and we have 7,000 taxable. Estate sale 3 is 2027, which will be tax year 27-28. And our gain will be 2,000. We will minus the 3,000 AEA, but since it is only 2,000, then we will take out only 2,000, and the taxable profit will be 0. From 2028-29 onward, no AEA will be available for the estate unless administration ended earlier, in which case it stops then with the end. But this example, it spreads over the first year, which is the death financial year, and then we have financial year of the second and a third. So basically we have 2 extra years, and starting from the fourth financial year 2028-29 there will be no AEA. So not the AEA of deceased person. What does this mean? After death, the deceased's own AEA ends. So this is not the AEA that we are using for the death person. It can only shelter gains the person made before death. From that point, the estate, through the executor's personal representatives, gets its own AEA, the same amount as individual, for a limited window, the tax year on death and the next 2 tax years. After that, the estate has no AEA. But let's not forget that for the trusts, it's 1,500. For individuals and PRs is 3,000. And this 3,000 for trusts, it's only for vulnerables, disabled beneficiaries. Vulnerables are, for example, teens. So the tax here on death and next 2 tax years. Spouses, civil partners each have their own AEA. You can transfer assets between you, no gain, no loss, before sale to use 2 AEAs. So partners can use double of AEAs. Alex has shares with £6,000. Before selling, Alex gives 50% to Sam, spouse. And Alex sells half to gain 3,000 gains covered by Alex's AEA, and Sam sells half, £3,000 gain covered by Sam's AEA. So they are basically still splitting the capital in 2 pieces in order to use AEAs for them both. And total UK CGT will be £0 because they have shares of 6,000. Sell a flat in New York. Do you pay UK CGT? If you are UK resident for that tax year, yes, the UK taxes your worldwide gains. So the New York sale is within UK CGT. And I wanted to have a red star. So even if you sell your apartment in New York, but you are a UK resident for that tax year, then you will pay capital gain tax. You still owe any US tax on that sale. The UK then gives foreign tax credit relief, so you don't get taxed twice. You can credit the US tax against your UK CGT on the same gain. Credit is kept at the UK tax on that gain. In this case, you still get the £3,000 annual exempt amount, then rates 18 and 24. You report it via self-assessment. There is no 60-day UK property return for an overseas property. So the 60 days, it worked for UK property only, and for residents and non-residents. And you remember that non-residents should have also did this report even if they don't pay any taxes, and residents should not report if they don't have to pay anything. The tax is basically 0. And for overseas property, there is no 60 days clock. Okay, we have gone through this as well. And for this video, let's finish CGT calculation, and only after that we will split this into 2 videos. So, CGT calculation. Step 1. Is there a disposal and when? A sale or a gift is a disposal, but not a gift to a spouse, a civil partner, or a charity. So if you're gifting to your partner or spouse, then it will not considered as a disposal. Part disposal, selling, gifting part of something. This also counts. Death is not a disposal for CGT. All gains in the year are assessed together. In a tax year, you add up all your disposals, sales, gifts that count, and cumulate the gains. You don't tax each one in isolation. You total them, then apply losses allowances rate to the net figure. Fix the date of disposal, exchange, or when conditions are met. We have spoken about date of disposal, which is the exchange of contract, unless the contract has a conditional date. Step 2, work out proceeds and costs. Proceeds are what you received as a consideration, cash or market value if gifted, under value. Allowable costs. So it meant with undervalue, if you gift something, if you sell something for £10, but its price is 1,000, so we are taking a market value, but only if gifted and if it was undervalued. But if you just sell something cheap, for example, it's 2,000, but you have used it and it's 1,000 now, or you want to make a discount, then it will still be 1,000 and not the market price. Allowable costs that you can deduct: what you paid to acquire, so your initial purchase price of the thing that you want to sell now, plus buying, selling fees, if there were like solicitor costs or financial consultant costs, plus capital improvements, if you have done renovations or any investments in your land, for example. Step 3, calculate the gain or loss. Gain equals proceeds minus allowable costs. If negative, it's an allowable loss. How do losses work? And this is important. Same year losses. You can offset losses from the same year against that year's gains. So if you had £10,000 losses and you then later had £10,000 gains, then you can offset them and you will have zero eventually. No carry back. You cannot use today's losses to reduce past year's gains. Carry forward. Any unused loss can be carried forward indefinitely to offset future gains. And let's mark it with green because it's really positive. So we made £10,000 loss this year, but we had £200,000 revenue gain last year, and we want to offset them, like bring back to last year so that we get more of last year's income. But no, we cannot do this. We cannot bring our capital losses to previous years. What we can do, we can keep our unused loss for the next years, and we can carry it forward indefinitely. And this is important because we can do it as long as we want. For capital gain taxes, we can carry forward our losses indefinitely. Spouses. Each spouse, civil partner, has their own gains losses. You can't merge losses between you. Though you can transfer assets, like the half of your assets, no gain, no loss, before a sale to plan who realizes the gain. So you can split an apartment into parts, like make an equitable owner, or you're another partner, and you will split the capital gain loss. Neither companies nor individuals can carry back capital losses to earlier years to offset past gains. Capital losses must first be set against capital gains of the same year tax. Any excess is then carried forward indefinitely, again, indefinitely, to offset future gains. There is no carry back. And the step 4, apply exemptions, reliefs. So what was the previous step? Calculate gain or loss. So you take your proceeds, what you have gained, and you take out all the costs, the purchase price, the losses of previous years, and any allowable costs that you had. And now it's time for exemptions and reliefs. Offset current year losses and brought forward losses. Deduct your annual exempt amount, AEA. Apply any reliefs, for example, PPR, for your main home. Whatever gain is left is taxed at an applicable CGT rate. So this is summarization of what we had. Annual exempt amount is this 3,000. PPR is our principal property relief, where we had 100% of relief. So basically you put a zero tax on that apartment if that was your main home. And about the current year losses and brought forward losses, like losses from previous years, we have spoken about that. Now a huge giant example. Annual exempt amount is £3,000. Current year gains is 90,000. Current year losses is 12,000. Brought forward losses is 60,000. Step 1. Net this year's gains with this year losses. It's 90,000 minus 12,000. Then we'll have 78,000. Then we're applying AEA, the allowance. and this will be 3,000. So we will have 75,000 taxable before using our losses, our bring forward losses, the losses from previous years. Step 3, use brought forward losses. Use up to £60,000 of brought forward losses. 75,000 minus 60,000, it will be 15,000 taxable gains left. Brought forward losses remaining to carry forward will be 0, so you cannot bring forward any losses anymore. Your taxable gain is 15,000. This is what CGT rate will apply to, split across your basic rate band if applicable. Bring forward losses left, £0. Why not use AEA later? Because the optimal order is offset current year losses, then use the AEA, then use bring forward losses. So the first thing that we offset will be our current year losses, and only after that we are taking out the AEA. Why is this done? So that you firstly use your previous year's loss, because current year loss, because every year you get this 3,000 and it will be refreshed every year. And it's bad for HMRC because they want to get as much tax as possible. And firstly, they want to get rid of your losses. Only after that, of this year, only after that, you can use this 3,000. So imagine if you had only 3,000 income, you will offset on 3,000 and you will carry forward your losses forever. Okay, this was it for this branch. Let's understand what costs you can deduct. Let's just quickly go through this as well and make it a bit longer video, but still it will be worth it. In corporate gain tax, your original purchase price is the core part of your assets base cost. It's the amount you originally paid to acquire the asset, and it's deducted from your sale proceeds when calculating the gain. You are taxed only on the profit, not on money you merely got back. So think of it as your starting stake. If you bought shares for £20,000 and later sell for 35,000, that 25,000 is deducted first. So it is your original purchase price. There are other extra costs you can deduct on top of the original purchase price when working out your CGT gain. The Taxation Chargeable Gains Act 1992 says that for assets like property, shares, etc., acquired before 31st March 1982, the base cost is rebased to the 1982 value. Let's just remember this year. It's the birth year of Niccolò Paganini, like 1782, not 1982, but 82 is Niccolò Paganini's year. And let's say Niccolò bought an apartment 200 years ago for £1, and in the gain will be offset, because if we are selling the apartment, which now costs 10 million, it won't be 9,999 pounds gain, but it will be offset, recalculated in 82. So we say how much this £1 apartment costs in 1982, and if it is, for example, 8 million, we then will calculate the gain not from £1 but from 8 million. And there will be more examples for this. Rebasing means resetting the purchase cost of an asset to its market value at a specific date set by law, so that any gains or losses before that date are ignored. For UK capital gains tax, assets held before 31st March 1982 are rebased to their value on that date, and only gains after then are taxed. So after that year, imagine someone bought a painting in 1917 for £2,000. In March 1928, its market value was 7,000. By 2024, the painting is sold for 25,000. Because of rebasing, the 1982 value, £7,000, is treated as the purchase cost. So capital gain is 25,000 minus 7,000 and not 2,000. Your gain will be 18,000. So it will reduce your gain, which is actually better for you. And this rebase, you just need to remember that on this year, the original purchase price of your asset changes. Now, there are other extra costs you can deduct, and this is one of them. Initial expenditure, buying costs or creating the asset. Costs you paid to buy or create the asset. Examples: property, shares, art, solicitor, conveyancer fees, survey valuation fees, stamp duty, tax, land registry fees, broker auction fees, necessary disbursements. So these are the costs that you get when you buy or create it. It's not about the purchase price, but it's about the extra costs that fall on you, and you can deduct them as well. If you build the asset, the construction costs, for example, building a weekend cottage, is also deductible. Subsequent expenditure, capital improvements and legal title costs. More money you spend after purchase that adds to the asset's value or secures, defends your title. So this is the money you spend after the purchase, not during the purchase. The previous one was your costs when you were purchasing, buying or creating your asset. And this one is the subsequent expenditure, which are capital costs and legal title costs, which we will discuss separately here: capital improvements and legal title costs. But they usually come after the purchase to add the assets value or secure and defend your title. They are both deductible. For example, capital improvements, including building an extension to your current asset, converting a loft, or adding a new room, installing permanent studio. And title rights costs are legal fees to establish, defend your ownership or rights. For example, some registrations that you had to do after a couple of years. For example, resolving boundary disputes, obtaining an easement right of way, they are also pricey. Not deductible are routine maintenance, repairs, painting, fixing a leak, insurance, security incentives, council tax, utilities. And I think insurance is also important, because you may think, okay, can I take out insurance costs from my capital gain? No, you cannot. Routine maintenance as well, they are repairs, etc. You cannot deduct them from as your costs. Incidental costs of disposal, selling costs, fees and commissions you pay to sell the asset. Examples are estate agent, auctioneer commission, solicitor's fees for the sale, valuation fees for the sale, advertising, marketing costs specifically for that disposal. So when you're trying to sell your asset, then all the costs connected with that can also be deducted. This was it for the first part of capital gain tax. Thanks for watching, and see you in the next episode.